Hi, this is Phil Greenwood in our next section of the Wisconsin Entrepreneurial Bootcamp Financial Statement Backgrounder series of podcasts. What we want to talk about in this section is to start the discussion on how to analyze the financial statements. We briefly discussed the income statement and balance sheet, looked at an example, the semantic numbers, and then also saw the example company, a startup, and how the various transactions got recorded. Now we want to be able to take an income statement and balance sheet and begin to create some ratios or measurements out of it to make a little more sense out of the trends in the company. Ratio analysis is simply combining various numbers in the financial statements and dividing one by the other and coming up with some kind of relative percentage or relative number that makes it easier to compare with previous time periods or other companies or such. Sometimes ratios do include non-financial numbers. We're going to stay with the financial side today, but you periodically come across efficiency ratings that may not include expenses or revenues, but it's just simply a ratio is a ratio, one number divided by another in relation to another. From a financial standpoint, we use ratios to look at the financial health of a company, including the operating results, but also we use financial ratios to help guide our projections. Sometimes we want to take our historical data and try to estimate several years out how well we might be doing based on the trends in the company, and the ratios help us do those projections by setting our future numbers to be consistent with the relationships that we see historically. And really where a lot of ratio analysis is used is it helps us understand our business, what's causing the changes in it, and also to draw comparisons, like I mentioned, between companies, between industry averages, between years and such. Just gives us a way to see how we're doing benchmarking ourselves against a variety of different benchmarks. Ratios are used by a variety of people. Managers use them to see how internally the company's doing. Typically, management within a company will have goals that they've set, financial goals, and ratios are one way that they help monitor how they're accomplishing their goals. Stockholders and analysts on Wall Street use ratios many times as part of their investment decision, whether they should buy or sell a stock in a company. Bankers use ratios once they've made a loan to a company to help monitor how well the company's doing, and also if they are in compliance with the agreement that was set up. For instance, a company will receive a loan from a bank, and many times a bank will say, we'll maintain this, you can keep this loan as long as you maintain a certain ratio based on whatever criteria the bank has set. And once you violate that ratio, or what we call a covenant, then it might put the loan in doubt and make it a callable loan, meaning the bank could ask the company to pay off the loan right away. And then finally, credit departments. These are departments within companies, say like a Symantec, who have to make judgments on whether they should sell to a particular customer or not. They'll receive financial information from the consumer, from the customer, help evaluate their risk and whether they're a good what terms they should give in the terms of the sales, and whether they should actually make any sales if a company or a customer is considered a bad risk. Now, from a semantic standpoint, here's the income statement from a previous session. Again, we can see the raw numbers. We made some conclusions. We know revenues are going up, gross profit going up, but net income not going down. Doesn't tell us a heck of a lot. Same thing with the balance sheet. We saw cash stayed about the same, receivables, accounts receivable increasing quite a bit, accounts payable going up, accrued expenses increasing, but still not a lot of meaningful information just looking at the raw numbers from one year to another. So this is where ratio analysis can help. So we can start taking one number, dividing it by a number, or looking at relative to another number to start looking at trends from a percentage standpoint to see, is there something meaningful changing within the business. One of the most important ratios we can use that really kind of is an overview of a business is return on assets. It's what we call a productivity ratio. In other words, it's net income divided by total assets, but what we're really asking is how much profits is the company or the management generating in relation to the assets that the company owns. Another way to look at it is net return on assets come out as the calculation as a percentage, and it will tell you for every dollar of assets the company owns, how effective are they generating a percent of income from it. And it's one of the more meaningful ratios that you can calculate to use to compare company to company, companies historically. As long as you have an income statement and a balance sheet, it's a pretty easy number to get at. So when we look at Symantec, we can calculate their return on assets using the income statement and balance sheet from 91 to 90. 1990, you saw the profits at 9.4 million divided by the total assets of 65 million. The return on assets would be in 1991 would be 14.4%. A question that always comes up is, well, is that a good or a bad number? And as we always like to say, it really depends. It depends what you're comparing it to. Well, if we compare it to 1990, you'll see that 1990 we had almost the same amount of profits, but a much lower asset base, and thus generated return on assets of a higher 19%. So from an overview standpoint, a person could look at this and say, well, the company had return on assets of 19% in 90, declined to below 15%, a significant reduction from the previous year. And so it could raise a lot of questions as to management, what's going on. Is it we're letting our assets get out of control? Are our profits not increasing fast enough? Or just what are the reasons or questions that we want to ask? And that's really what the reason for return on assets is. It gives you that big picture view of the company and the trends one year to the next, and then you can start drilling down or getting into the details to try to explain, especially in a case like Symantec, why this changed so dramatically lower from 90 to 91.